Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly video with our friends at Strategas. Today, we are lucky enough to be joined by technical strategist Todd Sohn to talk through all things markets. Todd, how are you doing today?
Hey Ross, great to speak with you again.
Yeah, really good to talk to you today. There's obviously a lot going on. I want to start with something that I've been increasingly interested in throughout this last couple of months, which is sentiment data, fund flows data, how that all comes together to form a picture of where we might be in the sell-off. Will we make a market low? What are you seeing broadly across that front, and how do you interpret it?
We always look to sentiment as a key component in our work, and nothing changes the sentiment backdrop like price, right? We've had a pretty good decline in the S&P, and especially across a lot of the NASDAQ. And what we're seeing now is our survey data, which we get weekly, has started to approach the territory where you're getting more bears than bulls in the survey data. And historically, that's consistent with above average returns over the following 6 months, right? We saw that in 2020, in 2016, in 2011. At a lot of important lows is when you start to get a good washout from sentiment data. Now that, curiously, it's not being reflected in the put call activity. We typically like to see the options market exhibit stress during these types of corrections, and that's the one element that hasn't been present just yet. So we'll continue to watch that to confirm what the sentiment data, the survey data specifically, is saying. Now, as for flows, what's curious about the flow work right now is that you're seeing an acceleration towards the bond proxies, consumer staples, and utilities have seen sharp inflows, right? We like that. That's folks getting a little more fearful, as well as treasuries and cash-like bonds. So a lot of folks selling their equities and moving towards a treasury and cash type backdrop. We think that's also consistent with finding some form of durable low. So overall, the sentiment picture is supportive here, but we still want to see it from the options market too to get that full blend of what we look for in terms of washed out sentiment. We'll continue to keep that as a day-by-day assessment.
Yeah, absolutely. Things are changing by the moment, it seems, so we'll keep an eye on it. You know, one thing you mentioned, and I'm curious to get your thoughts on, is despite all of the geopolitical turmoil, all of the COVID-19 pandemic turmoil of the last 18 months, flows into equity funds have really been kind of nonstop. It's been almost incredible. You've noted that the typical 60-40 portfolio has had one of its worst 2-month stretches in the last decade. Is there anything that can break the inflow into equities? Is there anything that can slow that down? What are your thoughts on that topic?
That's a great question. The 60-40 going through one of the tougher times we've seen in the last decade. I don't think any of us are used to it. Stocks are struggling, and bonds too, posting negative returns. And curiously, yeah, you've had equity inflows at records over the last year. I wonder if this type of environment where we're finally getting a steeper correction will slow down the inflows. But while you have this drawdown for a 60-40 portfolio, you're starting to see money flow into broad diversity commodity funds, which is interesting. So I think some of that could be momentum chasers, right? Folks looking for hot money because the returns have been so good across the commodity spectrum. But I also think it has to do with asset allocators saying, okay, the 60-40 portfolio may not be what we're used to going forward, assuming we're entering a more difficult equity backdrop and if bonds don't work as the way we're used to. So tactically, yeah, commodities are a little bit stretched here, but we like this idea of seeing more money flow into diversified commodity funds to act as a hedge towards a 60-40 portfolio. It's another component there to really shore up returns when you enter these drawdowns like we are in the current environment.
Yeah, and commodities certainly in focus right now, given so many of the supply crunches, across food commodities, metal commodities, and particularly oil is probably the biggest one in focus given the geopolitical turmoil. What are you all seeing from the price of oil and the energy sector as kind of a proxy? And how does that square with the weakness we've seen in the financial stocks? Because those have kind of traded together for a while as part of a broader value trade. I'm curious what you're making of all that activity.
Right, so with oil, we think there's runway towards 115-ish, and you may even touched it this morning. The trend is there, but just keep in mind, oil sentiment is very, very aggressive, whether it's anecdotal conversations or the survey data we have. So, I think oil, when you get full sentiment like this, is at risk of a reversion. So I would just keep that in mind tactically. But we're also dealing with the first correction in a decade or so where energy stocks have actually acted as leadership. Usually when the S&P has corrected, it was not energy. Energy was beaten down, financials were beaten down. So we're dealing with a different type of backdrop here. I don't think we should fear the strength from energy, although just keep in mind they are a bit stretched in a very short-term basis. Now, as it relates to financials, on one hand, I'm guessing the spike in oil helps those energy companies, but on the other, I wonder if financials are dealing with the fallout from what's going on abroad with a lot of geopolitical tension. You're seeing weakness in the big money center banks, but curiously, it hasn't translated down the Capsco where community banks and regional banks have actually held up pretty well. But overall, financials are entering a more difficult backdrop. You only have about half of stocks in uptrends now compared to over 90% last year. So things are getting much more selective. And while the near-term charts are sloppy, a lot of these names broke out of big structural 20-year ranges last year. And so we would look to get more aggressive in positioning, assuming there's another leg lower for a lot of these financial names, especially some of those big bellwethers. Don't get too afraid of another leg lower. It's going to be a more opportune time to start to add exposure to that sector again.
That's really good insight. Well, I want to thank you for your time. It's been really instructive, and we'll hopefully talk to you again soon as things develop. So I appreciate it.
Thanks, Russ. Appreciate it too.